Welcome to Market Brief After Hours. It has been an absolutely wild week in the markets, and we have a lot of ground to cover today. We are seeing a massive surge in semiconductor stocks, pushing U.S. equities into completely uncharted territory. But at the same time, there is a lot of underlying tension globally. Let's start right at the top with the key takeaways. The big indices have been making headlines. What exactly are the numbers looking like right now?
It really is a tale of two markets right now. But if you're looking at US tech, the momentum is just staggering. The S&P 500 climbed to a fresh record high. It rose 0.8% to close at 7,165. That is an all-time high on both a closing and an intraday basis, and it finished the week up around 0.6%. But the real star of the show was the Nasdaq.
The artificial intelligence trade just refuses to slow down, right?
Exactly. The Nasdaq Composite advanced 1.63% to set its own new record high, closing at 24,837. It finished the week up approximately 1.5%. We are seeing relentless demand for high-growth names, specifically in the semiconductor space. What's fascinating is that this rally is happening even as major players are tightening their belts. We had reports that Microsoft and Meta are moving to cut around 20,000 jobs, yet investors are looking right past that and focusing purely on the AI growth narrative.
It is incredible how resilient the tech sector has been, but not everything in the U.S. was flashing green. The Dow seemed to be dragging its feet.
That is right. The Dow Jones Industrial Average actually underperformed despite the broader market strength. It slipped 0.16%, or 80 points, to close at 49,231. It lagged behind because of weakness in some of its select non-tech components, which completely offset the gains we saw in the technology-heavy indices. The Dow ended up posting a weekly decline of around 0.4%.
So if the Nasdaq is the star, the supporting actors driving this plot are definitely the chip makers. Let's talk about the massive market movers. Intel and Nvidia have been front and center. What happened there?
Intel had an explosive day. The shares jumped a massive 24%, closing at $82.57. To put that into perspective, that is their strongest single-day gain since 1987. They delivered much better than expected quarterly results and issued a very upbeat outlook. It really shows a renewed confidence in their positioning within the AI space.
A gain like that for a legacy tech giant is practically unheard of these days. And Nvidia? They are already a behemoth.
They are, and they just keep growing. Nvidia rose 4.3% to close at $208.27. That is a fresh record high, and it officially pushed their market capitalization beyond the $5 trillion mark. The confidence in AI-driven demand is completely overriding the geopolitical tensions we are seeing in the Middle East right now. Investors are prioritizing corporate fundamentals.
Speaking of geopolitical tensions, that seems to be having a much heavier impact across the Atlantic. While the U.S. is riding this AI wave, the European markets are telling a very different story.
A completely different story. European equities closed broadly lower across the board. The Stoxx 600 was down 0.6%. If we look at specific countries, the UK's FTSE 100 fell more than 0.8%. That was its fifth consecutive decline, bringing its weekly loss to roughly 2.5%.
And it wasn't just the UK feeling the pressure, was it?
Not at all. In France, the CAC 40 dropped 0.75%, and macro data showed French consumer confidence weakening to a level of 84. Over in Italy, the FTSE MIB fell 0.52%. Germany's DAX edged lower by 0.11%, extending its losing streak, largely because German business morale fell sharply to 84.4, which is its lowest level since May 2020.
That is a stark contrast to the US. Were there any bright spots at all in Europe?
There were a couple of interesting data points. UK retail sales actually rose 0.7% in March, which beat expectations. However, rising energy costs tied to the Middle East conflict are really clouding that outlook. We also saw Spain's producer prices jump 3.4% year-on-year, again driven largely by a surge in energy costs. So even the positive data comes with a heavy caveat regarding inflation.
We are going to take a quick break, but when we come back, we will dive into the currency markets, look at some critical technical levels, and break down what is happening with oil and consumer sentiment. Stay tuned. Welcome back to Market Brief After Hours. Before the break, we covered the massive divergence between U.S. tech stocks and the struggling European markets.
Now, let's get into the foreign exchange markets. There has been a lot of movement, and I want to get into the technicals. How is the euro holding up?
The euro is actually showing some resilience. Euro USD pushed higher to close at 1.1718, up 0.3% for the session. What's really key here is where it sits relative to its moving averages. The pair is stabilizing above a crucial cluster. It's holding above the 50-day moving average at 1.1656, the 100-day at 1.1706, and the 200-day at 1.1675.
So buyers are stepping in on the dips?
Exactly. This firm positioning reflects improving short-term momentum after a period of consolidation. Immediate resistance is at 1.1721. If we see a sustained break above that, it opens the path toward 1.1800.
What about the British pound? You mentioned the FTSE 100 had a tough week, but how is the currency faring?
GBP USD actually extended its breakout. It closed at 1.3532, rising 0.49%. Much like the euro, it has moved decisively above its key technical levels. It cleared the 50-day moving average at 1.3411, the 100-day at 1.3459, and the 200-day at 1.3414. This reinforces a shift back toward a bullish structure. Price is currently testing resistance at 1.3533, and a move higher could expose 1.3650.
Let's look at North America. The Canadian dollar has had some interesting retail data come out. How did USD CAD react?
USD CAD actually slid lower, finishing at 1.3665, down 0.25%. The pair remained under pressure even though Canadian retail sales rose 0.7% in February to 72.06 billion Canadian dollars. The bearish trend here remains intact. The pair continues to trade below its major moving averages. The 50-day is at 1.3730, the 100-day is at 1.3736, and the 200-day is way up at 1.3816. If it breaks below support at 1.3663, we could see it drop toward the 1.3600 or even 1.3550 zones.
And over in Asia, the yen has been a major talking point lately. Are we seeing any shifts there?
While we are on the topic of technicals, let's touch on gold. It has been an interesting hedge lately.
Gold stabilized a bit, closing at $4,716, up 0.26%, but it is still within an ongoing correction. It is trading below the 50-day moving average at $4,869 and just under the 100-day at $4,728. The longer-term trend is supported by the 200-day moving average, way down at $4,226. But near-term momentum is subdued. Rallies are really struggling to gain traction right now.
Let's pivot back to the broader macro picture. We touched on energy costs earlier when discussing Europe. Oil prices have had a wild ride this week. Where do things stand?
Oil pulled back slightly today, but the weekly gains are still massive. US crude settled above $94 per barrel after a 1.51% decline on the day. Brent crude traded near $105.70, which extended its rally to a fifth consecutive session and posted a weekly gain of roughly 17%.
And how is all of this inflation and energy uncertainty hitting the average person?
Hard. US consumer sentiment fell to a record low of 49.8 in April. While 49.8 is a slight improvement from the preliminary reading, it is still well below March's 53.3. Inflation expectations for the year ahead eased slightly to 4.7%, but longer-term expectations actually rose to 3.5%. Consumers are definitely feeling the price pressures.
We also saw some shifts in Treasury yields today, coupled with some interesting news out of Washington.
Yes, US Treasury yields edged lower. The 10-year yield fell to 4.306%, and the 2-year yield dropped to 3.78%. A big catalyst here was the Department of Justice ending its investigation into Federal Reserve Chair Jerome Powell. This clears the path for a Senate vote on a potential successor, which actually adds a new layer of policy uncertainty. Even with the drop today, yields remain elevated compared to last week because of those rising oil prices.
Let's wrap up with a few more individual market movers. We covered Intel and Nvidia, but who else made waves today?
Organon & Co. had a massive day. Shares surged more than 32% amid reports that Sun Pharma is preparing a binding $13 billion offer for the company. We also saw Hims & Hers Health close up more than 8% after JP Morgan Chase initiated coverage with an overweight rating and a $35 price target.
On the flip side, who are the big losers?
Charter Communications plummeted more than 25% to lead the S&P 500 losers. They reported first-quarter earnings of $9.17 per share, which completely missed analyst estimates. HCA Healthcare also took a hit, closing down more than 9% after reporting first-quarter net income of $1.62 billion, again falling short of consensus expectations.
So, as we close out the week, it is a clear divergence. We have strong technology-led momentum pushing U.S. indices to record highs, completely overshadowing lingering macro uncertainty, soaring oil prices, and a cautious global backdrop in Europe and Asia. Attention will definitely turn to upcoming earnings and geopolitical developments to see if this incredible resilience in U.S. equities can hold up. Thank you for tuning in. If you find this useful, please follow Market Brief After Hours. We will see you next time.